Welcome back to the Deep Dive, your shortcut to being well-informed, especially with this Thursday morning edition covering major financial magazine headlines, everyone.
That's right. Today we're unpacking a whole stack of sources, MarketWatch, Bloomberg, CNBC, CNN, Yahoo Finance, Reuters.
And our mission, as always, is to dig out those really important nuggets of knowledge, figure out what's actually moving the markets. This Thursday morning, May 22nd, 2025.
Yeah, cutting through the noise, we'll be looking at why the stock market tumbled yesterday. Pretty significantly, actually.
And the bond market anxieties that seem to be connected. Lots of talk about U.S. fiscal health, potential tax policy changes.
Definitely. And then, sort of switching gears, there's this really striking counter-performance from Bitcoin.
Right. While everything else was down, Bitcoin was, well, up.
But that comes with its own set of issues, particularly crypto security, which we absolutely need to talk about based on one report.
Okay. And we'll also touch on bank stocks, some IPO news, other corporate headlines.
And yeah, that interesting, maybe slightly concerning story involving Elon Musk's DOGE project and government data.
All right. Quite a stack to get through. Let's dive in and see what these headlines are telling us.
Let's do it.
So starting with yesterday, Wednesday, May 21st, it was pretty rough for stocks. Reports from MarketWatch, CNN, they all show the major indexes finished way down.
Yeah, their worst day in about a month. The numbers are pretty stark. Dow Jones down 1.91%, S&P 500 off 1.61%, and the Nasdaq lost 1.41%. So yeah, broad-based selling.
And this wasn't happening to vacuum, right? It was linked pretty tightly to the bond market.
Exactly. Around the same time, we saw a bond market sell-off, bond prices fall, yields go up.
And the focus was really on the long end.
Very much so. The 30-year Treasury yield, it jumped back above 5% on Wednesday. MarketWatch had it hitting 5.091%, CNBC 5.085%.
That 5% level feels psychologically important.
It does. And this is the second time this week it broke that level. It's a high we really haven't seen since, October, November last year.
Wow. And the 10-year too?
Yep. The 10-year yield climbed as well, up to around 4.59%, maybe 4.61%, depending on the source. Highest since February.
Okay, so refresh our memory. Why is a spike in these long-term bond yields usually bad news for stocks?
Well, the key thing is rising long-dated Treasury yields generally mean higher borrowing costs across the economy. For households, think mortgages. For companies, think business loans.
Makes everything more expensive.
Right, and that makes stocks look less attractive compared to bonds, which are now offering a potentially higher, safer return. So money tends to shift, out of riskier stocks into safer bonds.
Makes sense. If you can lock in over 5% from Uncle Sam, the risk-reward for stocks changes.
Precisely.
So what specifically set off the bond market jitters yesterday? Sources point to a few things.
Yeah, a few triggers seem to converge. One was let's call it lackluster auction for $16 billion in 20-year Treasury bonds.
Lackluster how?
CNN reported it settled with a yield above 5%, 5.047% specifically. That signals that investors weren't exactly banging down the door to buy these bonds. They demanded a higher yield, suggesting weaker demand at lower rates.
Okay, so a weak auction. That's one flag. What else?
Then you have the ongoing sort of simmering concerns about the U.S. fiscal path, the debt, the deficit.
That seems to be a recurring theme.
It really is. And it was definitely amplified by Moody's downgrade of U.S. government debt last Friday. They dropped it from AA to AA1.
Right, I remember that.
And MarketWatch pointed out Moody's specifically cited large annual fiscal deficits and growing interest costs. That just fuels worries about whether treasuries are truly the ultimate safe haven they used to be perceived as.
So more perceived risk means investors want more return.
Exactly. And then the final piece yesterday, mentioned by MarketWatch and Reuters, was concerns swirling around that proposed bill in Washington to extend the 2017 tax cuts.
Yes, that bill keeps coming up. Seems like a real flashpoint.
It does. MarketWatch actually quoted strategists from BMO Capital Markets who basically said this sell-off, pushing the 30-year yield towards 5.1% is, and I quote, a troubling development if you see the Treasury market as like a barometer of investor approval of what's happening in Washington.
So the market is voting no on the current fiscal direction, or at least showing serious concern.
That's one interpretation, yeah. It suggests worries about fiscal responsibility. And, Bloomberg mentioned this isn't just a U.S. issue. Bonds from other big developed countries have been under pressure since April, too. Fiscal concerns are pretty widespread.
Okay, and let's dive deeper into that U.S. debt and deficit situation then. Sources like CNBC are painting a picture that's, quote, bad and potentially getting worse.
Yeah, and a huge focus highlighted across Reuters, MarketWatch, CNBC is this proposed Trump tax bill, sometimes called the One Big Beautiful Bill.
Right. What's the core worry there? The debt
Eh,
impact.
That's the key insight, yes, the potential hit to the national debt. Reuters cited nonpartisan analysts estimating it could add anywhere from $3 trillion to $5 trillion to the debt over 10 years.
Wow. Trillion with a T.
Yeah. MarketWatch had a CBO estimate specific to that bill at $3.8 trillion. Another source they cited put it at $2.3 trillion. Point is, whichever number you use, it's a huge potential increase in debt.
And there's this connection being made to potential Medicare cuts. That sounds politically explosive.
It is. And the mechanics, according to MarketWatch, are really interesting. The issue is, if this bill adds trillions to the debt without being paid for by other spending cuts or tax hikes, it could trigger automatic cuts elsewhere.
Automatic. How?
It's down to a law called the Pay-As-You-Go Act, or PIGO. Basically, it says if new legislation increases the deficit, certain programs face automatic, across-the-board cuts to offset it, unless Congress specifically waives the requirement or finds the money elsewhere.
I see. So the tax bill itself doesn't cut Medicare, but it could cause cuts via this PAYGO rule.
Exactly right. MarketWatch says the bill could trigger about $500 billion in these automatic Medicare cuts between 2027 and 2034. They noted the cuts are capped at 4% of Medicare's budget yearly, but still adds up to potentially $45 billion in 2026 and nearly $500 billion over that longer period, based on CBO figures they cited.
Okay, but you said could trigger. It's not a guarantee.
Right. MarketWatch was careful to point that out. Congress has often found ways around these PAYGO cuts in the past. They could waive it again, but the potential is there, and that's what's causing the reaction.
And the reaction sounds pretty strong based on the sources.
Oh, yeah. MarketWatch quoted Democrats like Rep. Ledger Fernandez and Rep. Boyle, calling the bill reckless, dishonest, and deeply harmful for potentially cutting Medicare while helping the wealthy. Advocacy groups like the Alliance for Retired Americans called it an assault and a betrayal, especially since President Trump had promised to protect Medicare.
Understandable reaction given the potential impact.
And MarketWatch detailed that potential impact could affect healthcare access for seniors, lower payments to doctors and hospitals,
Which could lead them to limit Medicare patients.
potentially, yeah, or increase out-of-pocket costs. And kind of ironically, one analyst noted it might even undercut fraud-fighting efforts.
So bringing it all back together, these big fiscal worries, the Moody's downgrade, the potential fallout from this tax bill via PAYGO, that's why bond investors are demanding higher yields.
That's the narrative connecting the dots, yes. The market is essentially pricing in higher fiscal risk for the U.S.
It's all interconnected.
Definitely.
Now let's pivot to something that went completely the other way yesterday. Bitcoin. While stocks and bonds were having a rough time.
Bitcoin was surging. It's a really striking divergence. According to Bloomberg and CNBC, Bitcoin hit new record highs Wednesday and Thursday.
New records. Like what levels?
It blew past $109,000 and $110,000. Bloomberg data had the peak at $111,878. Coinmetrics data cited by CNBC had it slightly higher at $111,886.41. Just huge moves.
Incredible, especially given the sell-off elsewhere. What's the key insight from the sources driving this rally? Why now?
It seems to be a mix of factors, but the two big takeaways are, one, mounting institutional demand, and two, Bitcoin being seen more and more as a hedge against instability in traditional fiat currencies.
That second point feels particularly relevant given our last discussion about U.S. fiscal concerns and the downgrade.
Absolutely. That Moody's downgrade definitely seemed to boost the digital gold or fiat hedge narrative.
Okay, so institutional demand and the hedge narrative, what specifics support those?
Well, Bloomberg and CNBC listed several things. On the institutional side, MicroStrategy keeps buying.
They always seem to be buying.
Right. Plus, there's more interest in crypto-related SPAC and PIPE deals. Even some smaller, more obscure companies are adding Bitcoin to their balance sheets.
Interesting.
And new crypto treasury firms are popping up. An affiliate of Cantor Fitzgerald working with Tether and SoftBank, for example. A subsidiary of Strive Enterprises merging with Asset Entities, Inc. to form another one. So real infrastructure being built.
So serious players getting involved, not just retail hype.
That seems to be the case. Also mentioned, growing optimism about U.S. crypto regulation, CNBC noted a stablecoin bill, the Genius Act, cleared a hurdle, and support from politicians described as pro-crypto, like President Trump and his advisor David Sachs, probably doesn't hurt sentiment either.
And the ETF flows, are they still strong?
Very strong. Bloomberg reported $4.2 billion flowed into U.S. Bitcoin ETFs just in May so far. That's clear institutional or at least broad investor demand.
Wow.
And Bloomberg also pointed to the options market. Lots of open interest on call options with really high strike prices, 110K, 120K, even some $300K calls expiring June 27th. Big bets on further upside.
So people are betting it goes even higher. Strike prices are the price they can buy it, right?
Exactly. It signals bullish expectations. And one analyst quoted by Bloomberg described the rally as not momentum-driven alone, but quantitatively underpinned by measurable, persistent demand and supply dislocations. Limited supply, post-halving, rising demand.
Is this lifting all crypto boats, though? Or just Bitcoin?
Mostly just Bitcoin, according to Bloomberg. Its outperformance compared to smaller cryptos or altcoins is actually widening. An altcoin index they track are down like 40% this year, while Bitcoin is up around 17%.
Huh. Interesting divergence within crypto, too. What's the outlook from here?
Well, one analyst quoted by Bloomberg suggested the dip below $75,000 back in April was probably just a correction within a bull market. But they also said a sustained break above $110,000 is needed to confirm the next leg higher, potentially towards $125,000.
Okay, so still some key levels to watch. Needs to hold these gains.
Right.
Okay, switching gears again, but staying with crypto. While the price is exciting for some, a Yahoo Finance report brought up a really critical vulnerability exposed by the recent Coinbase hack.
Yeah, this is a sobering story. And the key insight isn't about fancy blockchain exploits. It was old-school social engineering.
How so?
The attackers apparently bribed retail customer service agents in India to get access to customer data. We're talking names, addresses, IDs, transaction history, even account balances.
Wow, so the weak link was human, not technological.
Exactly, a fundamental vulnerability. Coinbase said it affected less than 1% of their monthly users, but a filing mentioned in the report stated 69,461 people are now at higher risk of identity theft or fraud.
That's still a lot of people whose data is potentially compromised. Did the attackers make demands?
They did, a $20 million ransom demand. But Coinbase CEO Brian Armstrong came out publicly, said they wouldn't pay.
Good for them. What are they doing instead?
They're setting up a $20 million reward program, a bounty for info leading to the arrest and conviction of the attackers, taking the fight to them, basically.
And for the affected customers.
Yahoo Finance reported Coinbase is notifying them, planning reimbursements, and looking at potentially relocating some of those support operations. But the potential cost is huge. An SEC filing estimated it could be between $180 million and $400 million for Coinbase.
Ouch. That's a massive hit. How did the stock react?
It dropped 7% when the news broke, though it's recovered some ground since. And the DOJ is investigating the hack itself. Coinbase reported it to them, so Coinbase isn't the target of the investigation.
Does the report suggest this is part of a wider trend, beyond just Coinbase?
Yes, and this is maybe the most concerning part. The Yahoo Finance piece highlighted a really disturbing increase in physical attacks targeting people and companies holding crypto.
Physical attacks, you mean like robbery?
Yes, and worse. The data showed 23 such attacks globally so far this year. That's almost 3 times the number from last year, and the highest since they started tracking in 2014.
That's terrifying. Puts a whole different light on crypto security.
Absolutely. The report mentioned horrible examples, like attempted kidnappings in France where victims actually lost fingers as attackers tried to force access to crypto wallets. It's a stark reminder that the risks aren't just digital anymore.
Grim stuff. Did the report mention if Coinbase's rivals face similar issues?
It did. It noted Binance and Kraken have faced similar social engineering attempts, but apparently managed to prevent data breaches. There was also some perspective suggesting Coinbase's structure might be more like traditional firms, maybe less prepared for these specific kinds of attacks.
And the idea of moving support staff, does that solve it?
Well, even the CEO seemed to suggest it might not be a perfect solve because the bribes offered could be tempting anywhere, even in the U.S. The core issue is the human element.
And there's a debate about how serious the fallout from the stolen data could be.
Yeah, a stark contrast. The CEO hopes the attackers realize they have nothing to gain by dumping the data, as it could make them accessories to worse crimes. But then, a Techrunch founder, quoted in the article, voiced a much darker concern, saying the hack will lead to people dying. Really highlights the potential real-world dangers.
A truly sobering counterpoint to the exciting price action in crypto.
Absolutely.
Okay, let's shift back to more traditional markets for a bit. Let's look at some specific sectors and companies from the headlines, starting with banks.
Right, MarketWatch had a piece on regional banks based on analysis from Jeffries, and the overall picture they painted was actually pretty positive for the sector.
Positive, despite rate worries and stuff.
Yeah, Jeffries expects things like loan growth to rebound, net interest margins to widen, credit quality to stay strong, capital levels are high, and they see attractive
Okay,
valuations.
attractive valuations.
So
What's the key insight driving that view?
it's about how they're priced compared to the broader market, like the S&P 500, and their own history. Jeffries noted regionals trade at about 52% of the S&P 500's forward PE ratio. Large caps are similar at 53%.
So relatively cheap compared to the market average.
That's the argument, yeah.
Right.
Especially compared to their 10-year average relative PE, which was higher. So Jeffries sees potential value there.
But they weren't bullish on all regional banks, were they?
No, definitely not. Despite the positive sector view, they actually slapped underperform ratings, basically, sell on 3 specific regionals out of the 32 they looked at.
Okay, which one's got the thumbs down and why?
The 3 were Cullen/Frost, Comerica, and Zions Bancorp. For Cullen/Frost, Jeffries felt the valuation was too high compared to peers, especially given expected earnings growth wasn't seen as top tier, though they did acknowledge a strong deposit base and capital.
And Comerica, what was the issue there?
With Comerica, a big factor was losing the Direct Express program, that's the one distributing federal benefits. Jeffries estimated that could mean losing about 15% of their non-interest-bearing deposits, which is significant. They also didn't see Comerica rushing into any mergers, which might limit growth.
Okay, and the third one, Zions Bancorp.
Zion's got the underperform rating due to a weaker earnings growth outlook compared to others, lower capital ratios than Jeffries likes to see, and importantly, vulnerability to credit problems because they have above-average exposure to commercial real estate.
Right, CRE is still a worry spot for some banks. So even in a sector with potential, you really have to look under the hood at individual names.
Absolutely. Company-specific risks are key.
What about the IPO market? Any signs of life there?
Yeah, some activity. According to CNBC, Hinge Health priced its IPO Wednesday night. They do digital physical therapy.
How did the pricing go?
It priced at $32 a share, which was actually the top end of their expected range. They raised about $273 million.
Sounds positive. What's the bigger picture insight here for the IPO market? Is it fully back?
Well, maybe not fully back, but the key insight isn't just that deals are getting done, it's at what price. Hinge Health's IPO valued the company around $2.6 billion.
Okay. Is that good or bad?
Well, it's way down from its private market valuation back in October 2021, which was $6.2 billion.
Ouch, a big haircut then.
A very big haircut. And CNBC framed this as potentially showing the tech IPO market is opening up after a tough couple of years, especially for digital health, which had cooled off post-COVID. But investors are clearly much more valuation sensitive now. The days of sky-high private valuations translating directly to public markets seem over, at least for now.
So the window might be open, but companies need realistic expectations on price.
Exactly. Investor discipline is back.
Okay, let's rapid fire through a few other interesting headlines from the sources. Lots of different things happening, tech and AI.
Big news there from CNBC. OpenAI is buying Jony Ive's AI device startup, IO, for about $6.4 billion. This is an all-equity deal. OpenAI already owned a chunk, so the net cost is closer to $5 billion.
Jony Ive, the Apple design guru. What did Apple stock do?
Apple shares fell in the news, down 2.3%, according to CNBC's Thursday report, and they're actually down 19% year-to-date. Seems investors are worried this signals real competition coming in the device space from OpenAI and Ive.
Yeah, pairing AI smarts with top-tier hardware design.
Right. One expert quoted by CNBC called it a shot across the bow. This is wartime.
Yeah.
Pretty strong words. Actually, the OpenAI is serious about hardware.
Indeed. Okay, what about semiconductors?
Also from CNBC, Nvidia CEO Jensen Huang apparently said Wednesday that the U.S. chip export controls aimed at China have been a failure.
Wow, that's blunt. Why does he think that?
He gave a few reasons, echoed by others in the report. Things like loopholes, China having existing stockpiles. But crucially, he argued it's hurting U.S. businesses more than stopping China. He pointed out Nvidia's market share in China dropped from like 95% to 50%.
So losing business.
And he argued it's actually incentivizing China to speed up developing its own chips. So the policy might be creating competitors while cutting U.S. firms off from a huge market. Unintended consequences, basically.
Interesting perspective from inside the industry. How about energy markets?
Bloomberg reported oil prices were down for a third day. Seems OPEC Plus members are talking about another potential production increase for July. A pretty big one, 411,000 barrels a day.
More supply hitting the market.
Potentially, yeah. And that adds to worries about a glut, especially with fears that slower economic growth or trade tensions could weaken energy demand down the line.
Okay, shifting to trading ideas. What are the Wall Street analysts recommending, according to Bloomberg?
Bloomberg highlighted a pair trade strategy being pushed by firms like UBS and Goldman Sachs.
Pair trade, meaning buy one thing, sell another.
Exactly. The recommendation is favor consumer stocks, which seem resilient maybe due to easing tariff worries or lower gas prices, and bet against areas sensitive to interest rates, like housing.
So, buy consumer staples discretionary short housing-related stuff.
That's the gist. Housing faces headwinds from those rising bond yields and mortgage rates we talked about. They cited metrics showing consumer stocks outperforming and the ratio of low-income consumer stocks versus housing hitting highs, suggesting relative strength.
And speaking of housing, any data out today?
Yeah, CNBC mentioned existing home sales data is due out today, Thursday. Context there is mortgage rates are still hovering around 7%, reinforcing that headwind for housing.
Got it. And any other quick company mentions?
Yeah, CNBC noted United Health slid after a downgrade. Ralph Lauren reports today, so eyes on consumer discretionary. TD Bank also reports. Home Depot has its shareholder meeting. And Reuters added that some solar stocks like First Solar were down because that tax cut bill we discussed might also end certain green energy subsidies.
Wow, so much interconnectedness. Tax policy hitting solar stocks, rates hitting housing.
It all ties together somehow.
Okay, let's wrap up with one more story that blends tech, government, and data privacy, concerns Elon Musk's DOGE project. What's the headline there from CNBC?
The headline is Senator Jeanne Shaheen urging President Trump to make Musk and his DOGE staff certify they won't misuse sensitive government data for personal gain after they leave government service.
Okay, DOGE. That's the project aimed at efficiency and cost-cutting in government, right?
Yeah.
What's the concern about data?
The context from the source is pretty striking. Apparently, Musk and the DOGE team got unprecedented access to sensitive data across a whole bunch of federal agencies: Social Security, Treasury, CFPB, CMS.
Wow, that's a lot of access to very sensitive personal and financial information.
Exactly. And the concern raised by the senator, as reported, is about what happens when these people, many from Musk's own companies, go back to the private sector. Could they use that non-public government data for an unfair and anti-competitive boost?
That does sound like a potential conflict of interest.
Especially since, as the report notes, DOGE targeted some agencies that actually regulate Musk's businesses. That adds another layer of concern about potential misuse down the line.
Is this just one senator's concern?
Interestingly, CNBC mentioned even figures like Steve Bannon share the concern, quoting him saying, "Trust but verify." So it seems to cross some political lines.
What did the White House say in response?
According to a senior official cited by CNBC, the White House essentially called the senator's letter pointless. Their argument is that these staff, as special government employees, are already bound by ethics rules preventing misuse of information. They think the existing rules cover it.
Okay, so a disagreement on whether current safeguards are enough. What about DOGE itself? Is it actually saving money like Musk claims?
Well, that's another point of debate highlighted in the CNBC report. Musk has claimed huge savings, like $160 billion for 2025-2026, aiming for $1 trillion eventually.
Big number.
Yeah, but other analysis, like from the New York Times or the Partnership of Public Service cited in the article, suggests DOGE might have overstated its impact. Some even argue it could cost taxpayers money. One group estimated $135 billion this fiscal year due to disruption, firing, hiring costs, stuff like that.
So the effectiveness and the cost savings are very much debated, alongside these ethical questions about data access.
Exactly. It really highlights the complexities when you bring private sector folks with their own interests deep inside government operations.
Okay, so let's try to wrap up this deep dive. We've covered a lot of ground, looking at these major financial magazine headlines. We started with the markets reacting pretty negatively to U.S. fiscal worries and rising rates.
Yeah, the key insight there being the bond market demanding higher yields as it prices in more risk related to debt, deficits, and potential policy like those tax cuts, underscored by the Moody's downgrade.
Right, and then completely contrasting that, you had Bitcoin surging to record highs.
Driven, it seems, by that combination of real institutional demand seen in ETF flows and other activity, and that narrative of Bitcoin as a hedge against exactly the kind of fiat currency instability people worry about when they see deficits ballooning.
But that crypto excitement was tempered by the Coinbase hack story.
Absolutely. A stark reminder that vulnerabilities exist, often in the human element, through social engineering, and the potential consequences, including those frightening physical attacks, are very real.
We also saw specific sector insights. Regional banks may be looking attractive overall, but with specific risks at certain names.
And the IPO market showing signs of life with Hinge Health, but the key insight being those much lower, more disciplined valuations compared to the private market frenzy. Plus all those other headlines, OpenAI moving into hardware, Nvidia critiquing chip controls, OPEC moves.
It really shows how these big macro themes, government debt, interest rates, policy debates, ripple through everything.
They really do. They affect investor confidence, they shape where capital flows, potentially driving interest in alternatives like crypto.
And these pressures, combined with specific events like data breaches or controversies over government projects, they inevitably influence the regulatory conversations we'll be having about banking, tech, crypto security, you name it.
Which leads to a good final thought for you, the listener, to mull over. As this debate about the U.S. fiscal path continues, how might it keep reshaping priorities for investors? And how might it influence the regulatory landscape across all these interconnected markets in the months ahead? It's definitely something worth watching.
Thanks for joining us for this deep dive into today's financial headlines. We really hope you found these connections useful, from bond yields and tax bills to Bitcoin and security concerns.
Keep an eye on how these stories develop.
We'll see you all tomorrow morning with new headlines from major financial magazines.